We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, Head of Research at Gold Money. Thanks for joining me today, Alasdair.
It's my pleasure, Tom.
It's always great to have you. And I thought we could kind of start today's conversation by going over maybe something that we tend to forget about on a day-to-day basis. So what are some of the, let's say, the risks of commercial banks being insolvent? And if there's an issue like, for example, a bank run, when something like that happens, maybe we could run through some of the ideas around, the risk of having your money in a bank, because it's not something that is necessarily on people's mind of every day, right?
Yeah, no, that's right. I think the majority of people don't actually understand that the deposit that they have in a bank is actually not their money, it's the bank's. The bank owes them that. And the distinction is actually very, very important because if the bank is wound up for any reason, there's a schedule of creditors. And in most jurisdictions, depositors are actually pretty much at the top of the list. So they'd be the first to be paid out. But the problem is, if you get caught in one of those situations, then you don't have access to your deposit. It's got to go through the receivership and all the rest of it. Now, having said that, the central bank will ensure as much as it can that depositors actually do have free access to their deposits. The role of central banks in this basically is, and this is very important, they have to ensure the integrity of the complete commercial banking system. Mm-hmm. If anyone fails, then the central bank has a huge, great problem on its hands. We saw this particularly with the Lehman crisis, when, for whatever reason, the Fed decided that they needed to make an example of a bank when all these banks were falling over, and they picked on Lehman. And the consequences of that were really pretty terrible. I think it was a big mistake on the Fed's part. In this country, the Bank of England even rescued small banks. It made sure that no bank went under. Mm. And it is a primary function of a central bank to ensure that a commercial bank doesn't go under and that depositors are protected. Now, I know that depositors are, in theory, guaranteed by various deposit protection schemes. I don't know what it is in Canada, but in this country, we're looking at about, I think, £85,000. Any deposit values above that are not protected. Mm-hmm. But there again, you see, there are complications, because if you've got more than one deposit and they total more than that, and the banks are related in some way, like one might be a subsidiary of another, they may operate under some sort of common license, then that's treated as one deposit. You're not going to get two lots of coverage. So there are various wrinkles that you've got to be really aware of. I think the biggest risk, because I really do think that the central banks learned the lesson of Lehman. You do not let a bank go under. It's as simple as that, and there's no reason for them to do so. But I think the wild card in this is the legislation that was passed at the behest of the G20 in all the G20 states, whereby, in the words of Gordon Brown, who was our Prime Minister at the time, the taxpayer shouldn't be on the hook for all the misdeeds of bankers. I mean, I'd say that's an emotional comment. Mm-hmm. From a politician. But the result is bail-in legislation. And all I can say is that if any central bank decides to try and bail in a commercial bank, then they're going to just create an enormous crisis. I like to think that commercial banks, through the Bank of International Settlements, have probably agreed between them that in the event of a banking crisis, the bail-in procedures will not be pursued. But I have no guarantee that that's the case. And I have no guarantee that one of the G20 might not have been listening properly. So there is...
Alasdair, if we could just for a second, define what a bail-in is for people that might not be familiar with that word.
Yes, sure. Well, a bailout is simple. Let's start with that. And that a bailout basically is central bank basically takes on board all the losses of a failing bank, whether it puts it into a bad bank or, sort of restructures it somehow. But the point is that all deposits are guaranteed. In the case of a bail-in, the idea is that the burden of the rescue should not fall on the central bank as much as possible. It should fall on the shareholders, it should fall on the bondholders, and it should also fall on the large deposit holders, the ones with, in our case, over £85,000. I'll just give you an example where that is actually very, very bad. I mean, I would guess that in Canada, you've got the same sort of thing. You have solicitors' accounts. These are accounts where client money is segregated into a common account. Say you're buying a property or something like that, and you would put deposits or the funds, if you like, from the sale of a house would go into the solicitor's account to begin with before it is sent to you. Now, if a bank goes bust, that account's going to have many millions in it, and that doesn't get rescued. So you could find that you're caught in the middle of this really nasty situation. So there is every reason why this bailout procedure should actually go ahead. Otherwise it's just too messy. But bail-ins, the first sign of a bank failing, you'll find that the bonds will start collapsing in value because bondholders are trying to get out. This is if they suspect a bail-in. Large depositors will just transfer the deposits elsewhere. In other words, they will create the very conditions that lead to the collapse of the bank. So bail-ins are actually counterproductive. And the other thing is that shareholders just end up being diluted down to zero. So you will see share prices falling in the stock market. You would see bond values collapsing, and you would see a run on the bank. And it's interesting, if you look at the recent history of Credit Suisse, most of these things have been evident there. I mean, Credit Suisse hasn't officially been bailed out, but I think unofficially there has been a lot of work going on in the background to ensure that that bank didn't fail, including persuading some very large shareholders from the Middle East, for example, to support the bank. And I think if the bank can be supported, it is a wonderful opportunity, perhaps, for some of these, let's say Middle Eastern potentates, who want actually to own their own bank in Switzerland. I mean, I would have thought there's some attractions for that. So I think that rescue is probably going to be successful. Now, having said that, the shares are valued at a very deep discount to the balance sheet book value. I calculated at the worst, it was something like 20% of book value. I mean, that's an 80% discount. You only get that if the market's in effect saying this bank's bust. There are various other banks in Europe on a similar rating, not quite as bad as that, but similar rating. So we're looking at a system where these risks are judged by the market to be actually quite real. Of course, in a bailout, you find that the shareholders actually do lose. I mean, it's as simple as that. They get just diluted right down. They lose in either case. It's really the treatment of the bondholders and the large depositors, which is the difference between a bailout and a bail-in. But Tom, there's something else I would add to this, and that is that thanks to all the quantitative easing, the central banks, all the major central banks have accumulated very large quantities of bonds on their books. In the case of the Bank of Japan, they've also got real estate investment trusts. They've got ETFs representing equities. I mean, but they've been doing it since the year 2000. I mean, this is very substantial. The result is that the fall in markets, the result of rising interest rates, has really wiped out all the central banks' equity. I mean, I look at the Fed, I look at the Bank of England, I look at the ECB, I look at the Bank of Japan. Now, normally this is not too much of a problem because a central bank can quite easily recapitalize itself with its government shareholder. But there is a problem in Europe, in the Eurozone, and that is that the ECB is not held by any government. It's not owned by government. It's owned by a consortium of national central banks in the Eurozone. And the problem there is that you do usually require legislation to recapitalize a national central bank. And I can just imagine the conversation in the Bundestag as some pesky politician actually says, now, hold on a minute. What are you doing about these target 2 imbalances? And you can immediately see how the whole of this recapitalization process could end up being extremely difficult. So I think the danger, to my mind, is probably, and there's no guarantee I'm right in this, but probably more with the central banking network than it is with the commercial banking network. I'm assuming that the central banks will do everything they can to bail out any failing commercial banks.
Yeah, it seems like just another real and very important layer of risk on top of the commercial banking system to really think about. And you mentioned this new paradigm of rising interest rates. What effect is that going to have on the derivative positions of these banks as well?
Well, I think the way to look at it is that the derivatives market had their origin in the 1980s, when interest rates were high, and they grew as interest rates fell. In other words, you can link the growth to a notional $600 trillion worth of nominal value of OTC derivatives, and there's another 40 trillion or so of regulated derivatives in the form of futures markets and so on. You can link that, basically, the growth of that, to declining interest rates. So, we declined to the point where we could decline no further, like the zero bound, and we now have rising rates. Now, it's not immediately going, sort of step. I mean, we've got a little bit more going here, but then decisions have got to be taken by the central banks about their priorities, which I'm sure we will come on to. But you can see that with a new trend of generally rising interest rates, fueled by price inflation, fueled by rising commodity prices. I know that they've come back quite a bit recently, fueled by higher producer prices, fueled by extended supply chains, which, they're sort of fixed to a degree, but it's been patched up and it's probably not really fit for purpose, certainly not fit for just-in-time inventory management. You can see that all these things are likely to lead to a completely different environment. Now, rising interest rates undermine financial values. It's as simple as that. As far as the banks are concerned, they increased the leverage in their balance sheets very substantially. I mean, I don't think we've seen them this high when we went down to zero rates, the zero bound in dollars, and we went into negative rates in Europe and also in Japan. That basically meant that banks increased their leverage in order to maintain their profitability, because their margins shrank with the lower and lower interest rates went. And now we've got rising interest rates. The initial effect of this is actually to improve bank profitability. But the cost of this is that they're going to have really, I think, a real escalation of bad debts, on their loans, non-performing loans, as the euphemism has it. And those non-performing loans are going to very quickly wipe out the capital, the equity capital of these banks. So as to your point about the security in the banking system, I mean, this is now a real life issue. And when you look at the average Eurozone bank, the ratio between balance sheet assets and equity is in excess of 20 times on average. On average. In Japan, it's in excess of 20 times on average. Mm-hmm. Not so bad in America. In America, you're looking at about 11 times, something like that, 11, 12 times. But we are not taking into account, and we're not making any assessment of off-balance sheet debt for which the bank might be liable. So as to your point about derivatives, if you look at sort of forward commitments, particularly in the foreign exchange market, which total around about $80 trillion equivalent, most of these have the dollar on one side and other currencies on the other. So you have got a real sort of, I mean, it's an iceberg. It's the under the water bit of the iceberg, if you like, which isn't actually recorded on the bank balance sheets. But that should be there because these are obligations which are settled in full. So the whole situation as far as the derivatives are concerned, I think is potentially very scary now that we are in the sort of contracting phase. Having seen it grow with declining interest rates, the whole of the derivatives market is going to begin to contract now that we have got rising interest rates. And I think that link has to be understood.
Mm-hmm. Yeah, again, it's just such in some ways, a very opaque risk that few people really understand. And as we're thinking about these risks to the mainstay financial markets that most people are really relying upon day to day, banks are obviously the first, the first tier on most people's minds. But as we recently saw in the UK, pensions could be at risk as well. So what does the future of the gilts market look like to you right now?
Well, that's a very good question. I would hope that that pension funds have learned a bit of a lesson. Mm-hmm. And to an extent, the reason for them trying to manage their liabilities has diminished with rising interest rates. We've actually now got some sort of nominal yield on the gilt market, which was creating the problem in the first place. I mean, that has come back to a degree. Having said that, the yield is still not sufficient to compensate a pension fund for the loss of purchasing power of the currency, which ultimately becomes the pension fund's responsibility to its beneficiaries. So they are not out of the woods at all. And I think that it was an example of the sort of problems that pension funds around the world face. I mean, the idea that this is just confined to some idiots in the UK, I think is not the case. This is a general worldwide problem. And it's not just pension funds. I mean, there are all sorts of other aspects which we're likely to find, for various reasons, suddenly implode on us. I mean, just looking at the repo market, interestingly, in America, the reverse repo position is over $2 trillion. Now, that is not a bad thing because it amounts to liquidity which is effectively taken out of the market. It's been surplus to the market. I mean, why? Because the Fed has been pumping up liquidity, I mean, to a ridiculous degree. So in effect, it's sitting there as latent monetary inflation or credit inflation, if you like. The situation in Europe is completely different. According to the sort of self-regulatory organization that does all the legal works and all the rest of it behind these things, they reckon that the Eurozone's repo amounts to something like 6 trillion euros. So this is not reverse repos, this is repos. Mm-hmm. So what we're saying is that the Euro commercial banking system, for its liquidity, is very, very heavily dependent on borrowing that liquidity, as it were, from either other banks, but mainly from the euro system itself, which is the ECB and the various national central banks. This is likely to become a problem because we're now beginning to see the cost of those repos rise. So liquidity is becoming expensive. Now, at what point that begins to choke off things, we will only know with the benefit of hindsight. Mm-hmm. Bear in mind that we're talking about banking systems which have loaned money to industry, to purely financial entities, which have got very used to the idea of very low interest rates. So if a bank's liquidity cost starts rising, because these repos are in effect replacing depositors who you would think would probably still be there on a zero rate. That's not the case. The cost of these repos is going to be rising. At what point do the margins really get squeezed so that the banks actually are no longer making any money on it? And what happens then? So, these are imponderables that are very difficult to answer ahead of an event. But I think all we can say is that we've got a little bit of time because everybody's talking about recession, which is taking a bit of pressure off the interest rate scene. Mm-hmm. And consequently, we're living for a little bit longer. But the assumption, and it's very much a Keynesian assumption, is that the slowing down of the economy basically will take pressure off rising prices. Mm-hmm. But that is to misunderstand what actually drives prices. I mean, the problem is likely to manifest itself in the foreign exchanges as holders of foreign currencies. And this is particularly the case for the dollar. Holders of foreign currencies find that the purchasing power of their foreign currency, or the dollar, is going down more rapidly than perhaps they thought yesterday. And on that basis, they will turn sellers. We're already seeing some unwinding of the position in dollars because at the height of it, I think we're about almost $34 trillion was recorded as being held by foreign entities, banks and insurance companies and whatever, non-American ones, countries even, in a range of everything from US treasuries all the way down to bank deposits. These are all financial, incidentally. We're not talking about, real assets, physical assets in America. That's a huge, great mountain. And as they begin to find that the purchasing power of the dollar goes down, all that's happening is that there will be massive selling in the foreign exchange markets. But because all the other currencies are in a similar position, what we're likely to see is, the impact will really be on commodities, producer prices, that end of things, as it were. Despite the fact that, and it will become a fact of that, I'm absolutely certain, despite the fact that the world is entering a recession.
Mm-hmm. Well, as we talk about this worldwide or global recession that we're headed to, you recently added literally one line to the end of an article that I'd like to touch on more with you. And the line was, the final word is reserved for China. Inflation is low and money supply is growing again, signaling an Asian recovery to soften a global recession. So, I think that deserves a little bit more of an explanation than just one sentence, Alasdair, if we could.
Yeah, sure. China is interesting because, as a managed economy, our experience of politicians managing an economy hasn't been a happy one. In China, it's interesting, let's put it that way. But we're beginning to see money supply increase again, which basically means that nominal GDP is recovering. And whether it follows through or not, remains to be seen. But they're in a completely different position from us. And one of the differences I'd like to point out is that the banking system isn't independent of the government. The government controls the banking system. So, in effect, the government turns around and instructs banks what their lending policy should be. I think that there is, if you like, a sort of change in emphasis in the economy. I think that the Chinese leadership recognizes that with the way the relationship with the West is changing, with the Western alliance, I mean, it's particularly changed as far as Russia is concerned. I think it's made them very much aware that they've got to accelerate a program to be less dependent on the Western alliance for its trade. And and I think that there is going to be very substantial further investment in, the Silk Road and the maritime equivalent, and the spurs going up to it, and so on and so forth. That is going to be increasing hugely. And you can see that China is also securing the resources for this. Earlier last month, she struck a deal with Qatar for the supply of liquid natural gas for 27 years. I mean, that's a long-term commitment. Mm-hmm. Who in the West, offers that sort of business to an energy producer? And here are we, sort of trying to get rid of fossil fuels. I mean, we're not customers for the Middle East anymore. And, and to the point, this is why President Xi goes over to Saudi Arabia, has extremely friendly meetings with Mohammed bin Salman. Mm-hmm. And, you contrast the half-hearted fist bump that Mohammed bin Salman gave to Biden, and that was all Biden got, compared with, I mean, they really rolled out the red carpet for President Xi. That is the way in which the whole of Asia is going. Mm-hmm. And we've got to understand that we're becoming isolated in this. So the idea that you've got one world, one economy, and everybody's going in the same direction, it is true of the Western Alliance, but it is not true of Asia. Asia is on a completely different path. Mm-hmm. And I picked up something very interesting the other day as well. The all this brouhaha about the Hong Kongers fleeing Hong Kong and all the rest of it. We had lots and lots of people applying to come and live in this country. I mean, good educated Chinese, or ethnic Chinese with. Many of them educated in Britain, and I mean, Hong Kong was incredibly successful. So you've got a lot of money, you've got a lot of Chinese skill, and all those things which make China just an extraordinary country. A lot of that is encapsulated in the Hong Kong population. But you know what? They're going back. I mean, this is the amazing thing. So the idea that Hong Kong is, sort of being trashed and all the rest of it, and people are going to continue to come out of Hong Kong. Well, I mean, there's bound to be some, but the big money is going back. The family offices, the sort of, if you like, the ethnic Chinese family offices, that sort of thing, they're all going back into Hong Kong. And interestingly, they're going into Hong Kong rather than Singapore. So this is telling me that the outlook for China, Hong Kong, China, is actually potentially quite dynamic, and it's going to be very, very different from what we're talking about in our currencies, mm-hmm. which brings us on to, I'm probably getting ahead of you a little bit, but it brings us on to another point, and that is that China and Russia, their priorities have changed. I mean, in the past, they were almost trying not to upset the financial apple cart with their progress. But now I think that it's far more important for them to protect themselves against currency issues in the Western alliance. And those currency issues, I think, are going to become very real, particularly as we find that the financial system just can't take the strains.
Mm-hmm. Well, going back just a little bit, I saw you kind of tweeted, let's say midweek last week, that there was a possibility that there would be trade for oil in, let's say, yuan, for example. Yeah. I believe it was literally the next day it was announced that China told the Gulf nations to use the Shanghai Exchange for yuan energy deals. So is this, just another maybe nail in the coffin for the petrodollar?
Yeah, absolutely. Well, petrodollar's dead. Forget it. I mean, that's gone. I mean, in the sense that one of its creators is now walking away from it. But this is an interesting point because, I mean, we have effectively, with our anti-fossil fuel policies, told the Saudis and their neighbors, we don't want you anymore. We're going to get rid of everything that that we need from you in terms of energy and all the rest of it. So go away. You can't quite go away, but you know what I mean. And so, yeah, they've turned. They have turned to China. I mean, it's simple as that. And you can see that Russia, as the largest exporter of energy, larger than Saudi Arabia because of its gas, is similarly getting together all its resources. So you've got the whole of the Middle East, you've got all Russia, you've got Iran and so on, and all this is coming together outside us. It's got nothing to do with us. And the problem for the Saudis is that what do they replace the dollar with? I think in a sense they would like to feel that the yuan is secure, but bear in mind that as recently as the 1960s and 70s, the Bedouin Arabs who were if you like, the fathers of the current generation of Arab leaders, only recognized one form of money, and that was metallic coin. So you can see that their experience with the dollar is harking back. It's making them hark back to gold. Mm-hmm. And I think that either of two things the two things I should draw to your attention. One is that Sergei Glaziev, who is a very senior economist in Russia and advises at the highest levels, is head of the Eurasian Economic Union Committee, looking at this new trade currency concept. And all we had was initial announcements earlier this year as to which way this was likely to go. But bearing in mind that Glaziev is also the moving light behind the new Moscow Gold Exchange, I think that gives us a clue as to how this might go. Now, if I put myself in Mohammed bin Salman's shoes, I think I would like to see a trade settlement currency which is credibly backed by gold. Then I would be happy to hold on to that currency. Mm-hmm. In the absence of that, and they do seem to be taking a little time to make up their mind as to how this is going to happen, I think that the Saudis would probably exchange some of their surplus with China. And I think the trade surplus with China amounts to around about $30 billion equivalent. Mm-hmm. I think they'd probably turn some of that, and that's incidentally about 550 tons. I think they'd probably turn some of that into gold. I think the way to look at it is probably not, the whole amount, but traditionally what, sort of, if you like, really large exporters, those seeking to protect their own currencies, their own position, would probably take somewhere between 10 and 20% of foreign currencies and sell those for gold. So they would be accumulating gold reserves alongside any increase that they would have in terms of foreign currencies. So I think we're probably looking at a new source of demand from Saudi Arabia, somewhere in excess of 100 tons a year, as a result of this, moving closer to China. Mm-hmm. And I wouldn't be surprised if we see this crystallized with an announcement of an oil agreement, rather like the Qatari one with gas, say for 25 years plus, Saudi Arabia agrees to supply X million barrels a day or whatever the figure, whatever it is to China. So I can see that that's the way this is going, and it's very, very important to understand it. And of course, the implications as far as the dollar is concerned is that I referred to 34 trillion earlier in dollars. That's fallen to about 32, I think, maybe a bit less. A lot of the holders of those dollars now will have less of a need for holding dollars, or even no need at all. So you can see that at the sovereign level, there is likely to be some considerable liquidation of foreign dollar liquidity.
Mm-hmm. Yeah, it just seems that there are so many things at play here, and that there's just so many factors kind of pointing in gold's direction. And I think it's just a matter of time. And we'll talk about a little bit of the current market conditions for gold and silver in a little bit. But, one of the other things I want to kind of tie into this idea of the world really grappling with the consequences of a rising interest rate environment is the idea of how that affects Bitcoin and how Bitcoin really grew up in that environment. So how do you see that difference in this new paradigm for Bitcoin itself, Alasdair?
Well, it's an interesting conundrum. I mean, what's happened with Bitcoin? Look, Bitcoin has been very robust. You've had all the attacks on, systemic attacks on the crypto market and all the rest of it, but Bitcoin has sort of sailed through. So I'm not saying that Bitcoin is risky in the sense that it's likely to sort of suddenly collapse under some sort of attack or whatever. I don't see that. I think the thing that's interesting, as to your point, is that the Bitcoin bull market has been it's one of those things that has gone with declining interest rates. I mean, and particularly as interest rates decline to ridiculously low levels, considerably less than even the official rate of inflation. And, when you take John Williams' work on, what the more likely rate of CPI inflation is, you can see that, the interest rates are so horribly mispriced that you would get speculative bubbles in things like cryptocurrencies. There is, the thing that's interesting is that as we get rising interest rates, I have very little doubt in my mind that this will be, if you like, counterproductive as far as Bitcoin's price is concerned. I think it will undermine it. Mm-hmm. Because I do attach it to, that long-term trend. It was, if you like, it's a speculative bubble is the way I'd put it. And I know I'm going to upset a lot of people by describing it like that. But I see it as a speculative bubble at the end of that long period of declining interest rates down to the zero bound, where anything financial was basically going through the roof on a valuation basis. So I think that the interesting thing is that if you look at what happens to the relationship between gold and interest rates, the way it is working at the moment, and bear in mind that bullion markets are driven completely by derivatives. There's a shortage of bullion in the market at the moment, but do we see a massive revaluation of gold and silver? No, we don't. We see it's just sort of recovered almost pari passu with the fall in the dollar's trade weighted. I mean, that's so what? But from the point of view of hedge fund traders, they would see rising interest rates as working against gold and being good for the dollar. Mm-hmm. So they would sell gold, buy dollar. And more recently, they've seen a decline in the prospective rate of interest rates. So you would think that they would have sold dollar to buy gold. And that indeed is what they should be doing. But actually, if you look at the turnover figures that are going and the commitment of traders numbers and the open interest on COMEX, they haven't been doing that at all. They've just been sitting on their hands. Mm-hmm. Now, to give this a better context, I think that when people understand that the problem is really inflation and it's going to lead to higher interest rates and the central banks are dragging their heels, what happens is that you get a rise in interest rates and you get a rise in the price of gold. I mean, looking back in the 1970s, which is when I came into the finance industry, going into the 1970s, around about 1971, 72, Fed funds rate sort of varied between about 3.3% and 5.6%. Mm-hmm. Gold was $35 or $42 or whatever. Anyway, at the end of the decade, we had gold fixed January 1980, 81, thereabouts, I think 81, at $850. What was the rate of Fed funds rate? It was up at it was about 14%. So in other words, it's not a question of high rates penalize holders of gold. I mean, they've got it completely wrong. There are far greater forces at work. And so the conclusion I would make from that is that the market so far is not actually taking the inflation threat seriously. If we saw people piling into gold on rising interest rates, then I think we can say they're taking inflation seriously. But as far as Bitcoin is concerned, I would expect under those circumstances to see the Bitcoin price fall because it is not legal money. There's a lot of hope that it could be legal money, but it's not. The only legal money, and we're not talking about dollars, that's not legal money, that's currency. Legal money is only one thing, and that is metallic coin, generally represented today in the form of gold coin. And it's been so for over 2,000 years. And before that, it was accepted in the markets as legal money. So, and it's important to understand the difference between money and credit. What we deal in always is credit. Central bank credit, commercial bank credit. There is only one form of money, and this was actually something that the original J.P. Morgan said in evidence to Congress in 1912. He said gold is money and the rest is credit. Mm-hmm. And he was dead right. He wasn't expressing a biased view that he liked pet rocks or anything like that. It was quite clear he was stating the legal position, and he was right, and he's still right. Even though we may be banned from holding it, which I wouldn't rule out.
Mm-hmm. So, you touched on a point there about the commitment of traders reports and open interest. So if you could explain that a little bit further. We've seen open interest really get driven down, and I want to, let's say, understand that a little bit better, Alasdair, if you could.
Yeah, I mean, the way COMEX is structured is that you have got, on the one side, you've got speculators, and on the other side, you've got what are called producers. But actually, some of those producers are not producers at all. They're just sort of a mixture of market makers and traders in the form of swaps. Mm-hmm. And that's where the bullion banks really reside. I think something like 60, 70% of swaps activity is actually bullion bank trading desks. They take the short end, the short side of the market. So when the speculators, principally in the form of hedge funds and similar in the managed money category, when they get bullish, you find that obviously, the price rises, or it's probably risen by then, actually. That's another story. But they always end up long at the top. And it is the function of the bullion banks basically to hold their nerve, because they know that when it's all overbought, they know where all the stops are. They know how to shake the trees. They're very clever, these guys. They're very experienced. They know their business. Mm-hmm. And they make billions, basically, out of the ineptitude of hedge funds trying to trade paper gold. So the relevance of open interest is that when open interest is low, the speculative interest is low. When it is high, the speculative interest is high. So when you see very low open interest, which is the current situation, then you know that the market is extremely oversold. Mm-hmm. Now, we've had this rise, which has taken gold up, $160 or something like that, $620 to the current level, which is about $1,780, $1,790. And the hedge funds just haven't really got involved in it at all. We're seeing lower open interest. And what this tells us is that there's been a bit of a bear squeeze. That rally is on the back of a bear squeeze, but there's no way it's overbought because the punters just haven't gone into it. And then there's another dynamic as well, and that is that, and I think principally it's the other reported category, which basically is a sort of mixture of everything, which can be anybody. That category tends to, sort of buy contracts for investment purposes, if I can put it that way. So they would expect the trend to improve, and what they will do is they will just sit on a position rather than be shaken out by, being over leveraged and all the rest of it. And increasingly, of course, they've also been standing to take delivery, because when there's a shortage of stuff on the open market, if you're going to get it, then what you do is you buy a future, or you buy a forward in the London market and say, yes, please, I'll have it. Which upsets everybody, incidentally, because that's not how this game should be played. So anyway, that's the relationship between open interest and where we are in the market. And it's interesting because quite a lot of traders, who trade with Elliott Wave and so on and so forth, they're looking at stochastics and so on. And these are sort of pretty mechanical things. They'll say, oh, it's overbought, and so it's due for a reaction. And, if you're an Elliott Wave expert, you count up 5, and so that's an impulse move. That's come to an end. We've got to have a correction and so on. Yeah, well, maybe. But I still think that this very low level of open interest is the thing you should be looking at, not, all this mumbo jumbo, but Elliott Wave or stochastics or whatever it is.
Mm-hmm. Yeah, it's going to be interesting to see what the path is ahead, because it really, in some ways, it puts the odds against each other for technical analysis versus maybe, let's say, something that might be considered more of a fundamental, like the open interest and the actual appetite of the market, right?
Mm-hmm. Yeah, I can add something to that. I mean, I cut my teeth in the stock market, and in those days, we had jobbers and we had brokers. And the distinction was that a jobber could only deal with a member of the stock exchange, but could not deal with a member of the public. Whereas a broker couldn't deal with another broker, but he could only act on his own behalf or as an agent for a member of the public. And he could only deal with the jobbers. So they were the market makers, if you like. Mm-hmm. And, when you had a floor, you got to know these guys too. And you began to understand how they ran their books. They were always on the short tack. But what they lost on the short tack, if a price continued to rise, they more than made up by trading. And, they would make a market, in far larger quantities than they would have in their book. The amount of capital that a jobber actually required to run positions across the market wasn't all that great. It's considerably less than what the banks deploy at the moment. But you very quickly learn that while there are things like, technical analysis, and you can look at a company's fundamentals, and, there are various ways in which you can seek to maximize the return on an investment, or make profits. Actually, in the short term, what really matters is how the jobber actually sees his position and his sense of feel for where the buyers and sellers are. And it's the management of the market, in that sense, by a specialist, which really determines how things move in the short term. And so in that sense, I would say that sort of market feel is more important, certainly in the short term, I think, than any technical analysis. Mm-hmm. Though I wouldn't dismiss technical analysis out of hand. I would just say, in terms of relative importance, understanding what's going on in the market, I would say is important. It's the most important factor. Right.
Well, to that point, when we saw, let's say, the beginning of the war in the Ukraine, the beginning of Russian aggression there, that seemed to move the market based on fear. So I want to get a little bit about how you're seeing what's going on with the war in Ukraine and its effects on Europe heading into these cold winter months here. Is there starting to be dissension in the Western alliance between the American-led NATO and the Europeans?
Well, I think there is. It's not yet public, but you can just sort of detect that there are increasing concerns. I mean, there's always been concern in Germany over this situation, partly because of her dependence on energy, partly because she's had to write off a lot of business in Russia. Or rather, her companies have, And you've also got, I think, increasing worries ahead of the winter as to what the effect of Russian policy is, because Putin is no fool. I mean, we try and show him to be an absolute idiot in the Western media, and I mean, really, when I see what our establishment here, how it sort of deals with propaganda and all the rest of it, it's enough to make you weep. It really is. The reality is that Putin is an extremely wily opponent. He knows what he is doing, and his latest move is very, very simple. I would call it a reverse siege, rather than sort of surrounding in medieval times. You would surround a city, a walled city, and you would make sure nobody got out. You'd make sure no food got in. You would starve them out, and they would submit and capitulate. What Putin is doing is he's removing the infrastructure. He's bombing all the electricity supply and all the rest of it, water and so on. And he's just making it impossible for 34 million ethnic Ukrainians to live in the Ukraine. Mm-hmm. So, with that and with food shortages, you're going to get a very, very nasty winter in Ukraine, and you're bound to have a huge refugee problem. Why is he doing this? Well, he basically wants to split the Western alliance. He wants America and Britain to leave him and Europe alone, and to get Europe, for the first time since the war, to actually manage its own affairs. He wants to see NATO effectively neutralized, and I think the foreign secretary said, someone said, how far do you want to see him go back? And he said, well, as far as the missiles will go. He's talking about the NATO moving back 300 miles. Mm-hmm. So you can see that. Anyway, I think the point is that I think America can now see this problem arising in Europe, and America's problem is how to extricate itself from the position. And not only that, but if, let us say, there was a ceasefire over the Ukraine, with the possibility that leads to some sort of agreement, that would take a lot of pressure off energy prices. And I think that governments understand this, and I think the American government understands it. So, we're getting to a point, I think, where the war against Putin, which is the way I'd put the Western approach, the American and British approach, I think they're beginning to realize that that's not actually going to work, and they need to back down for the sake of their own economies. So in this sense, I think we live in interesting times. I mean, in the Chinese sense, not not in the positive sense.
Yeah, the curse of living in interesting times.
Exactly.
Yeah. Well, Alasdair, there's so much going on in the world, and I appreciate you giving us some time and some ideas on how to try to make sense of it and put it all in order. Is there anything else you'd like to mention before we wrap up here today?
I don't think so. I mean, in terms of what does one do? I don't give investment advice. That's the first thing. Mm-hmm. But to increase the amount of money in your possession, I think makes sense. And that is not investment advice, if you like, because money is not an investment. Okay. But I think that anyone who sort of understands that we've got some of these major problems ahead of us, you needn't necessarily agree with me entirely, and then does nothing about it, I think is taking a huge, great personal risk. And so I would urge people to think very, very hard about this change of trend in interest rates, the implications for the whole of the West financial system, the splitting of the world into two parts where, they used to say America was the policeman for the world. Now it's the policeman for about a third of the world, or even less, in terms of population. And, unfortunately, we're not part of the dynamic end, so that I think has huge implications as well. So all these things, I think, do require people to, just take a step back and think, how can I protect myself from all these changes.
Mhm.
And these are changes which I think are bound to lead to, if not currency, outright destruction of Western currencies, certainly a very, very substantial reduction in their purchasing power. So I think there's a lot for your viewers, listeners to consider.
Mhm. Yeah, and on the back of the idea of not giving financial advice, there's probably a good distinction there to be made between money and currency, right?
Yes, I mean, basically, you acquire money, and this is a big difference between gold and Bitcoin, incidentally. Eventually, in order to spend it, so you hoard it, if you like, call it an insurance policy against fiat currency going wrong. Mm-hmm. You do not, and a lot of people do this, and they're mistaken. You do not buy gold with an idea that you're going to trade it out at a profit at a higher price. That is not the way to look at it. Mm-hmm. Because actually, what we're doing is you acquire gold, you acquire silver, physical, either in coin or in bar form, in the knowledge that what you're doing is you're escaping a collapsing fiat currency. This is not something that you do in order to make a profit in a fiat currency. Mm-hmm. A very, very important distinction. And I would urge everybody to try and, if you don't get it immediately, just think about that, because this is not investment. We're not mm-hmm. talking about investment. We're talking about protection.
Mm-hmm. Excellent, Alasdair. Of course, all the articles that you and I kind of touched on today, based a lot of this conversation on, are available at goldmoney.com under the research tab. And you put links to most of them up as well on your Twitter at Macleod Finance, right?
That's correct. Yes, that's absolutely right.
Excellent. Thank you so much for your time today, Alasdair. I always appreciate getting to speak with you and having you on the show.
It's very much my pleasure, Tom. Thank you for asking me.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.